We've heard a lot today about the way that the banks and alternative finance interact. Isn't the reality that actually all of the range of alternative finance propositions out there don't matter to the banks? It's just so small. And what they'll do is they'll just cherry pick it all, won't they? They'll just go, that's an interesting idea, I'll have that. And in a sense, the model for the relationship between alternative finance and banks is one element, which is nice idea, we'll steal that. And the other element is, well, we'll work with people opportunistically when it makes sense, because it does. And we've heard about Funding Circle working with a large list of banks. That was a good list of banks earlier on. There's no real threat in that behaviour, is there? There's no alternative finance companies that are going to really take over the banks. We've had our events at headlines, banks RIP, not in a million years.
So Jeff Mitelman from Thinking Capital. We are a small business lender focused on the Canadian market. And we've been in the business 9 years, and for the first 8 of those years, we were a direct lender. And as the established banks and large brands in the country have started to express an interest in the alternative lending space and fintech at large, we've been somewhat viewed as the incumbent alternative in the country. So we've had a fair bit of experience dealing with the largest banks in the country, and I would say you're quite right in your initial assessment. We don't move their needle at this time. I think the value proposition that we have fundamentally, certainly at this part of our journey, is what ultimately drives banks are accounts and deposits. And not so much the revenue that small ticket lending generates.
Yeah.
So the way in which certainly we're being viewed by the partners that we have is this is a way to change the conversation around assets and deposits with the part of the overall market that we've historically been very bad at communicating with.
So effectively, if I could sort of simplify that in a simple way, it's just they look at you as a way of addressing certain niches. Which it makes sense with on-deck working with Chase as well, that quite often they're working particular areas where the banks may not have, for a variety of reasons, been that efficient at dealing with stuff, and they just use you to effectively augment.
I think taking the view that says the economics in the form of referral fees or any balance sheet that we could generate for the partners at this time, the more tangible, measurable aspects of what we're doing, pales in comparison to the opportunity to change something that's a little bit more, intangible, which is the lifetime value of the relationship that they're having with these merchants in particular. Much harder to measure, but ultimately at scale, far more important to the bank as an organization, and I think we're only at the beginning of the journey to realize that.
So Joel Rackham with Lendio. We are currently the largest marketplace for the borrower, for the merchant in the U.S. And so we have an interesting position in that the industry itself, I would say the industry and the banks, maybe 2 years ago there was a sentiment that we were going to overtake the banks at some point in the future. And I heard a couple comments about that. What we're finding is that's not necessarily true, and that's shifting for us in particular. So we aggregate all lenders and provide the borrower an option, and hopefully provide them an option faster than a bank could, and obviously provide trust in the same way that eBay would provide trust to. Instead of using Craigslist, you'd never buy anything off Craigslist sight unseen, but you do it all the time with eBay. In that same way, we are developing trust with the merchants that are coming to us. And so banks are recognizing, and I would support what Jeff was saying. What we're finding is the bank is coming to us and saying, look, these small loans, we can't financially make sense of that. But the lifetime value of that relationship is meaningful to us. And there's enough of those relationships that we don't want to lose it to the bank down the street if they can finance and we can't. And so they're coming to us more as a partner, to help that business get funding. And as that business grows and becomes more in line with what they would lend to, that business through Lendio has a chance to go back to that bank as well. And so that bank never really loses that. They now have a co-branded marketplace, if you will, and a co-branded experience all the way through the process. And it doesn't matter who lends on the back end, Lendio and that bank can still maintain its customer relations, and we can maintain ours as well. So we're seeing there's more eagerness to play beyond just they're competitive, they're our competitor. It's more of they see the value of the long-term relationship with that customer over just the financing.
I'll come back to in a minute or two, the nature of where the value is and which bits of the relationship they're interested in. I'll come back to in a second. Christopher, from an EY perspective, we heard this isn't really a disruptive space any longer, really, is it? It's sort of a kind of nice technology add-on to a bank's. I'm being facetious and a bit cynical, but in a sense, it's just something that the banks can deploy to basically make their proposition better. So the classic example is everybody gets very excited about fintech and revolutionising banking. Simple was the online bank that everybody talked about, bought by BBVA. Yeah, so they either co-opt, augment, use it to augment, and that's the model moving. There's no real disruption to the banking model going on at all, really, is there?
I would argue that, Chris Harris, so I run EY's consulting group for banking here in North America. So most of our clients are the ops and techs divisions or the lines of business in their larger regional and global banks. And so this conversation for me, is mostly with those guys. And I would summarize it by saying, in general, I think they view alternative lending as an opportunity. So most of them, and I believe the small business and business banking specifically in terms of an area is an opportunity where they say, this is really neither the consumer bank, it's neither the wholesale bank for us, it's an area where we have high volume, relatively standard need for credit, and we have kind of systematically underfunded in it, underinvested in it for years and years. And that's just one typical example of a bank environment that is not effectively dealing with its customer that alternative lenders are bringing to that space. So what Thinking Capital does, as I understand your business model for your clients, is quite frankly just obviate the failed spaghetti infrastructure of the bank's existing small business origination environment and do that for them. And so before the rise of this market and this innovation, those banks separately had to say, all right, where am I going to put the next dollar of investment to spend in the infrastructure investment that I have, which is already overly complicated. My systems don't talk to each other. My customer experience is opaque. It's slow. It's unreliable. And what alternative finance represents for these guys is a business model, a front end, a technology and analytics, or customer experience that is better than what they have today and viewed as a complement. I just would say, though, to your question, though, every bank also says, yeah, but which one is the next monoline major player, like an American Express? So is there a scenario that says that an alternative lender really gains the ownership of the customer and the brand power to be that standalone entity? And so it feels like it's years and years away, but everybody's looking over their shoulder.
Just to sit with you for a second, Christopher, we talk about SMEs here mainly. Sorry, small and medium-sized enterprises, English term. Are the banks really at all interested in what a lot of the alternative lenders are doing in the consumer space? Or are they just looking at it and thinking, nah, we're not worried about that?
Well, so I think that's an opportunity for partnership, but I think banks, not to oversimplify, but I think generally not too worried about it. They feel like they can be competitive. Yeah. The opportunity, though, is in the very large underbanked and unbanked segment. So as I
was going to ask about that kind of, I don't know, I hesitate to use the words America, but subprime, but so well down the ladder, who's might be backed by credit unions or local community banks. Is that where the real opportunity in the consumer space is?
It is because what I think you see in, for example, OnDeck's partnership with JP Morgan, again, small business is an underwriting model that's saying yes more often than JP Morgan's own model is doing, and the same applies in the underbanked segment. You'd say when you have a consumer that is otherwise not fitting a bank's risk profile, there might be a business partner out there and capital behind it that will lend to that. And if they can exploit that market and be a player, be a revenue generator in it, then that's a huge space.
As before we just move on to look at some of the kind of value propositions where the most value is in, one question just come up actually, which is very relevant to this. We sort of look at, just as we can't characterise all alternative lenders as the same thing, because SME lenders have got a different attitude and consumer lenders have a different thing. But the banks aren't all the same. We all think that they're all big monolithic banks, but actually there are as we've already said, there are the big banks, the big nationwide banks, and then you've got, in the UK particularly, you've got challenger banks, who relatively new, quite often digitally enabled, and then you've got the community banks and the the credit unions and that kind of stuff. Looking at the challenger banks, for instance, particularly, in the UK, it's a very noticeable trend. They're much more likely to work with the alternative finance platforms because they sort of get it. They both got a common enemy. And is that true in America as well?
So I'll speak, but I don't want to dominate.
Absolutely.
The real issue with especially a millennial generation is that banks are viewed as sort of the enemy. And so I think a huge opportunity in AltFi is that, ironically, customers, especially a millennial generation, don't value stability, they don't value regulation, they don't value managed customer experience. They value what they call trust, which is in the relationship, a customer experience, my interaction, a digital layer that speaks to me. And so the opportunity for a bank to be able to be branded in that way is the opportunity to grow. I think the walk for Wells Fargo to tell that story is a lot longer than an Ally Bank that already is viewed as an online bank that tries to position itself as technology. And so the brand alignment, I think, is tighter, which makes it more natural. And those companies are desperate for growth. That seems like they're obvious.
Jeff, are you finding some banks easier to work with than others?
I would answer that question as relative contribution. And what I would say is the smaller the bank, typically the larger of a financial impact we could have with them a whole lot sooner. There's also a reputational element that the larger the bank, the more hurdles you have to jump through to form a partnership. From our experience, the early adopters have been a number of in Canada we don't call them challenger banks, but the B tier banks have certainly adopted it quicker. We did a partnership with a bank called CIBC, which is a top 5 bank in the country, and it took us the better part of a year and a half to put up.
Sure.
I think there's two things. One, in your question, why would a bank really need to partner with an alternative lender or a marketplace that aggregates those alternative lenders? And in the U.S., there's some unique things that are happening and that have happened. One of the regulations with a credit union, for example, is they can only lend a certain amount of their assets. Yeah. So at some point, even if they would normally say no and it's an attractive borrower to them, they have to say no. They don't have the assets to lend because it's capped, essentially. And then for a bank, again, it goes back to what we originally said, which is sometimes they just don't know how to say yes because it doesn't fit within their normal parameters. It's not a customer that they want to say, we don't like you, we don't want you. But it's definitely something where they're trying to identify that. And in our case, it's been nice because those banks or those credit unions that want to have more of a product to offer these SMEs and to speak to the UK term, or the SMBs, is instead of managing 15 or 20 different lender types and alternative lenders, they have Lendio do that on their behalf.
Christopher, are there any kind of hotspots for where this augmentation, cooperation is going to be much more important in the next few years? We all talked about generally small and medium-sized businesses. Are there any particular bits in that spectrum that, from an EY perspective, you think are worth watching, where the banks are really going to be interested in what these guys are doing?
I think where the banks are watching the most is in the technology and in the analytics. So I think the banking industry is very fascinated by the potential for underwriting models that are different than what they're used to. But there's also a huge amount of cynicism about that because there hasn't been really a recession to test it in since the crisis. So the opportunity to partner with providers that are testing these models and really see where that world goes, I think, is a big focus area for banking.
Actually, can I just pick up on that point? Because one of our keynote speakers earlier on, Jeremiah, was talking about there is no new credit paradigm. There really isn't any magic bullet which gives you a better credit using credit analysis, using big data. Do you think the banks think that? Do they just think, these guys all think they can basically analyze stuff better than we can, and it's just not true?
I think that there is the door is open for the conversation about what is the analytics, sweet spot, secret sauce that hasn't been hit yet. They are very conscious. I mean, but any bank would say that whether it's true or not, there are secret sauces in their risk management.
Yeah.
And in reality, they depend very heavily on relatively traditional models, especially in commodity consumer lending. And so the opportunity that may come up from what a SoFi has done, for example, or some of the lenders that are bringing the algorithm that supposedly said, that may or may not give good validity to the unknown consumer. That's a great unexplored space. Social media, I think the average client I talk to is still this little bit of a head scratcher, like is there something really there to tap? And they look to big data and analytics to really help tell that story and look at AltFi as a way to test that market.
Joe and Jeff, I mean, there's no real secret sauce in any of these risk analytics, is there? You're effectively just using old-fashioned credit methods. You can't really use big data and algorithms to better analyze risk, can you?
So from our perspective, when we first started, we started in the business almost 10 years ago now. Nobody in their right mind in a country as conservative as Canada would have lent us any money to acquire loan assets. So we started lending our equity right out of the get-go. And as you build up time, and you keep eating your own dog food, people become very interested in portfolio performance and what the vintages have done over and over again. And one of the ways which we bridge the gap to the conversation between, hey, we've been operating through 8 vintages, and this is what we look like. How do we translate our credit performance into how you would have scored these assets? And we've gone to the market and used some of the better known consultancies to basically intermediate and stress test our portfolio. So I would argue that our approach is highly differentiated from the bank's approach at taking risk, and I think the opportunity that it creates in a highly differentiated approach is it expands the addressable market for who you can serve together.
Jeff, don't mind me asking, but what is your secret sauce then?
What is the secret sauce? I mean, in our case, one of the things we've aggregated that banks haven't is historical payments data in the country. So we use historical payments data as a part of our underwriting models that banks historically haven't used in there.
I'll just throw in real quickly. I think just knowing nothing about the relationship that you guys have with CIBC, the very fact that they would enter into that agreement with you is an acknowledgement by them that you have something they haven't been able to do on their own. They wouldn't have entered into that easily.
That's true. Joe, what's your secret sauce?
Yeah, I think for us, so I would argue with your point that big data doesn't provide any benefits. There certainly is, but our motto is option, speed, trust. And I don't think that's very different than any other alternative lender or somebody that's trying to disrupt the market, if you will. But things such as utilizing verified addresses up front and integrating in for quick scores, they're all great. Everybody can API in and create a lot of those. But it's how you leverage and evaluate bank statements and other things, and how you put together financials very quickly with that data in a way that the banks haven't figured out yet. It's the very reason that big banks are coming in and saying, hey, we see something here. And back to Chris's point that there's obviously a reason they're coming in. They're seeing things that they're not using. But I would certainly argue that there is. We're figuring out the big data faster than banks can do that themselves. Is that a sustained competitive advantage? I don't know yet, but it's certainly right now we're operating ahead of the banks there.
Sure.
If I could add one more point to that, I think the inputs that all of the alternatives use to ultimately render a decision pale in comparison to something that we call lending by losing, learning by losing. And those are the data points that you accumulate by turning around and taking a hypothesis, putting some dollars against it and going and lending against the hypothesis, circling back and said, what did I do right and what do I do wrong? And then ultimately, building up a knowledge base that says, I've made so many mistakes to get myself to this point. Having had the experience of tens of thousands of loans in market, what starts to build up an important part of how we look at our IP is the experiential data that we've built in putting out so many loans.
But I would also argue that you're actually getting to an important cultural point. When tens of thousands become millions of loans, there becomes a culture of avoidance of that risk. So it becomes very hard to test that. What I think most major banks deal with is the culture that does not empower, it's just not used to innovation. And so whether it's big data, whether it's scoring models, whether it's just understanding where and how we might have changed to do better, an average bank, I think, recognizes that they suck at that. And so Altify, again, is an opportunity to try to bring in the culture of that innovation and that experimentation, albeit maybe at arm's length. You certainly see that right now. There's not a lot of acquisition. And over time, the testing of that when we move through enough economic cycles and scale to really see what's durable.
One last question for you. You talked a lot about technology, but it always strikes me from my kind of cynical journalistic point of view that quite often you should talk about product. And the reason the banks have got a stranglehold, for instance, in the small and medium-sized business market is because they provide bank accounts. And they provide overdrafts. Well, they don't actually, but they used to provide overdrafts and credit facilities. And you know what? Funny, call me old-fashioned, but they're quite useful, actually. So, and actually, a lot of alternative finance providers are very focused on loans or invoice funding or something like that. It strikes me that you're never really going to be able to take on the banks until you take on what is their real strength, which is they have the primary relationship with the end customer. Same with consumers. They have a bank account and they have overdraft. And no one in the alternative finance space is really looking to do that. In a sense, you're all like, in the nicest possible way, you're stinging different bits of them, but you're not getting the central relationship. And if you usurp the central relationship, then everything changes.
And by partnering with the banks, you're playing into that diabolical web.
Yeah,
I think
perfectly put.
When we think, joking, but when we think about over the horizon a little bit, it's with open APIs and the technologies and partnerships that allow customers to control the full nature of their relationship for financial services products across the things that they do, that you begin to develop the feel of an ecosystem that has a bank involved, if not a bank at the heart of it.
Yeah.
And the more that I think companies play for niche capabilities that augment that experience but don't ultimately control the overall relationship, then you become a slave to the ecosystem. You're not the driver in it.
George, what do you think? You've effectively have got to innovate with new products because the end customer needs new products to change their relationship with banks.
Yeah, and it's an interesting question from our perspective, Lendio's perspective, because we're different than a direct lender.
Absolutely.
And so for us, we're almost rooting for the bank and the lender relationship, right? Because we have somewhere to play in there. If you think of technology, they originated a channel, right? HP. And you've got players like CDW that are just distributing their products. They're marrying that buyer with HP. We're not much different than that. So for us, we want both to succeed. We like alternative and we like banks because we want to marry them to a borrower. So,
Jeff, last question for you. I mean, you've got to really take the banks on. You've really got to play at the Moa game. And you're going to launch a current account.
I would say that at this point of adoption by the by the consumer of alternative lending, it's still really low, and one of the things that people overlook in the conversation is why if it were available would people would many still wish to borrow from the banks, and a lot of that has to do with trust in a brand that's been built over often centuries. So when you put up a website, it almost doesn't matter how slick it is, and how great the user experience. There's still a large segment of the base that wants to feel like they're dealing with a trusted brand. So at this part of the journey, the combination of the trusted brand with the slick user interface and data database back end that creates a fluid borrowing experience is a way to increase adoption, which frankly is what most of the alternatives struggle with right now is the primary challenge.
Okay, we're going to have to call it a day there. Put your hands together for our last panel. Thank you very much. Thank you very much, gentlemen.